Welcome to the Geopolitical Compass, guiding investments in a volatile world. Today, we're diving deep into a topic crucial for every investor: how global politics directly impacts your financial decisions. In an interconnected world, geopolitical events are no longer distant news. They are fundamental drivers of market shifts, influencing everything from commodity prices to corporate profitability. This video will help you understand these forces and equip you to navigate global investment risks. Geopolitical risk in investment refers to the potential negative impact on financial assets due to political instability, international conflicts, or policy changes between nations. It's about how world events shape global markets and the value of your investments. Think of it this way. A political decision in one country can send shockwaves across continents, affecting supply chains, consumer demand, and investor confidence. Understanding these dynamics is key to making informed investment choices. As of June 2025, several key geopolitical scenarios are particularly impactful. Let's examine some of the most significant ones that are currently shaping global markets. The evolving US-China relationship, marked by economic competition and technological rivalry, continues to be a major factor. Tariffs, trade policies, and tech sanctions have direct implications for global supply chains and specific industries. The ongoing Russia-Ukraine conflict has profoundly impacted energy markets, commodity prices, and European economies. Its ripple effects extend to inflation, global trade routes, and defense spending worldwide. Persistent tensions in the Middle East significantly influence global energy markets. Any instability in this region can lead to price volatility in oil and gas, affecting transportation, manufacturing, and consumer costs globally. Beyond direct conflicts, geopolitics is fundamentally reshaping global supply chains. Concepts like de-risking and friendshoring are becoming central to corporate strategies, moving away from a purely cost-driven globalization. Companies are actively de-risking their supply chains by diversifying sourcing, reducing reliance on single regions, and even bringing production closer to home. This often means higher costs but greater resilience in times of crisis. Friendshoring, or relocating supply chains to politically aligned nations, is gaining traction. This contrasts with the traditional model of pure globalization, prioritizing political stability and trustworthiness over just efficiency. Another significant impact of geopolitics is the increasing regulatory fragmentation across different regions. This creates a complex landscape for international businesses and investors. Countries are enacting diverse data privacy laws, trade regulations, and investment screening mechanisms. Navigating these varied and evolving regulations requires constant vigilance and adaptability for multinational corporations. This fragmentation can increase operational costs, limit market access, and complicate compliance efforts. It forces businesses to reevaluate their global strategies and investors to consider regulatory risk more deeply. So how can investors navigate this increasingly volatile and fragmented world? Here are some key investment strategies to build resilience and manage geopolitical risks. Diversification remains paramount. Spread your investments across different asset classes like stocks, bonds, real estate, and commodities. Crucially, also diversify geographically to mitigate risks concentrated in specific regions. Focus on companies with strong balance sheets, diversified revenue streams, and adaptable supply chains. These resilient businesses are better equipped to withstand geopolitical shocks and market downturns. Consider markets with relative political stability and strong domestic growth drivers. India, for example, often presents an attractive opportunity due to its large domestic market and ongoing economic reforms, making it somewhat insulated from certain global tensions. In conclusion, geopolitical factors are increasingly central to successful investment. Ignoring them is no longer an option. We've covered what geopolitical risk is, its current manifestations in US-China relations, the Russia-Ukraine conflict, and Middle East tensions. We also explored its impact on supply chains and regulatory fragmentation, and strategies for smart investing. Staying informed, continuously adapting your strategies, and seeking diversified opportunities are essential. The world is volatile, but with the right compass, you can navigate it successfully. Please remember, this video is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial advisor before making any investment decisions. Thank you for watching.